Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have back the CEO, Dirk Maritz from Atlas Engineered Products to give us an update. Atlas trades on the TSX Venture Exchange under the symbol AEP and on the OTC under APEUF. The company is trading at 35 cents with roughly 58 million shares outstanding, or about a $20 million market cap. I'd now like to hand it over to Paul Andriola.
Awesome. Thank you, Trevor. Yes, Dirk, happy to have you back. It's good to see you. It's been a long time since we saw you. We've, I think it was about 6 months ago where we last had you on. So obviously a chance for the company to make some significant progress, which I see you have. Good set of numbers this last quarter. So happy to have you on. And like we always like to do with this, why don't you give us a brief reminder of what Atlas is all about.
Thank you very much, Paul, for the invite. I really appreciate to be here and to have the audience to speak to us, some of our friends. Atlas Engineered Products, we're in the space of manufacturing pre-manufactured building components, that is roof trusses, pre-manufactured wall panels, flooring systems, engineered wood, etc., etc. We're on a mission to consolidate this industry across Canada, and we continue to looking to do so.
Right on, right on. So the last set of numbers, which I believe was Q3, we saw a decent profit, over $400,000. We've seen a nice top line of call it 9.7 million. This is all during COVID. Let's jump right in and start talking about some of the challenges you've been facing during COVID and maybe some of the opportunities. We spoke just before we started the podcast that some of the issues were around labor and some shortages there, but I understand that's been somewhat addressed. Why don't you let us know how things are going?
Just to put the last quarter's results into perspective, Q2, in the depth of COVID, we had an 11% increase over the first quarter, and the 9.7 million represented another 22% increase over the second quarter. So during the pandemic, really a strong position for us to be in. And like I've mentioned in the previous announcement that has gone out, when we announced the Q3 results, we actually entered Q4 2020 with record work on hand at that point in time. And it's looking really good for us to actually be banking on that as we speak at this point in time. So really a good news story overall. The year was a very interesting one, Paul. Back in Q1, very sudden, deep changes in the industry. The economies in various parts of the country actually shutting down, albeit that we were deemed an essential service. We had to do quite a lot of work to make sure that we can produce in factories where people used to work shoulder to shoulder almost, in safe distance areas. You had high lumber volatility throughout the year. We saw record lows in the beginning of the year, and we saw record highs by the third quarter. And we're seeing some of that stability comes back. But one of the biggest things that I'm seeing is the macro stimulants, because of the pandemic, is really suiting our business and our targeted segments really well. You're seeing record numbers of single-family homes, multi-families, when it is townhomes, etc., going up across all of our territories, and we see a very, very strong trend in that regard into the sort of 2021 year as well. Then other products, we've done quite a bit of work on product development. We've entered, for example, the Vancouver market with the pre-manufactured walls. We've implemented that plant there, and I'm happy to say, it appears that it is fully booked up into 2021 at the moment. So it's going really, really well with that. Huge demand for those products. Remember, what happens is less labor required on site, less people working shoulder to shoulder, a third of the time of traditional build by using pre-manufactured wall panels. So really, really exciting piece. We've done a little bit of expansion with a new startup in mainland BC, for example. And that is going very well at the moment as well. So overall, a number of big things that we've done over the last few quarters. And we're looking forward to a couple of strong quarters coming here at us over the next little while. And then very important, you know, from a liquidity and from a sort of a cash perspective, we've raised some money earlier this year. We still got that money intact. And we've managed to pay down a little bit of debt as well over this last year. So it's a very strong position for us to be in. We're really well positioned to actually start acting on our further acquisition plans here over the next number of months and into 2021.
So excellent. I mean, a big part of the story is M&A. We discussed that in the past. And what's interesting is it sounds like there's been a lot more tightening of integration. So you've managed to, you know, you've owned some of these facilities now for you know, in some cases a couple of years. Tell us, how's the streamlining going? That's been one of my concerns, is to see how the integration is going and sort of the cutting of costs or any sort of waste. How is that going?
I can cite you specific examples. You know, when you're integrating these businesses and at the pace that we were acquiring back in 2018, 2019, what has happened is you were buying smaller businesses. I'm thinking of one of our businesses out in Ontario, for example. The business only at that point in time generated maybe about $1.6 million worth of revenues. They maybe delivered about $200,000 worth of EBITDA, et cetera, et cetera. You know, 2 years later, that business has now shown a 94% increase over those sort of revenue numbers. When you're looking at the margins have gone up from, in this specific instance that I'm looking at, probably from about 22, 23% to well over 30, 35%. In that sort of facility. And that's one example. But not all of these integrations or companies are created equally. You know, it's when you move into it, it takes time for you to actually facilitate those growth numbers, to actually streamline the operations, to update equipment, to get the people side of it sorted out, et cetera, et cetera. So it's really looking very good for us at this point in time with these facilities. We've done a lot of the integration work. They're in various places or on the sort of a curve at this point. And we want to make sure that the lessons that we've learned in the past, we can do that now twice as fast as we've done it in the previously. So really good position for us to be in.
Yeah, no, that's it's good that you mentioned that, because obviously the more practice you have doing this, the easier and the tighter the controls are. So I'm really happy to hear that. Let's go back to something you touched on. You know, we have seen the company move into the Vancouver Lower Mainland area, but we've also seen the wall panel sort of component become a bigger fixture within the business. Give us a little bit more sort of sight on that. Why did you move into Vancouver, and how's that going? And then more importantly, really the wall panels, I'm very, very interested in hearing how those pieces are going, because that's a pretty exciting part of the business for sure.
It is huge. It is huge. You know, the sort of a potential for organic growth through product diversification in this industry is massive. I'll give you an example. During 2019, we did a small boutique hotel in the Michigan area. This hotel, when we originally quoted the job, the roof side, just the roof truss side of this little hotel was probably about $120,000 US. When we added just the outside walls and the main flooring system for this hotel, that became a $750,000 contract. That's the multiple of potential growth that you can generate in this industry as we're converting more and more builders into prefabricated wall panel systems. So it is super exciting. We have earlier this year took some plant, refurbished it, and installed it in our Nanaimo operations on Vancouver Island. It was super exciting to actually see what is happening there, because what has happened literally in the space of weeks, customers were coming to come and have a look and see where are we installing it. What is it going to look like? What's the quality controls that's going to be in place, etc., etc. And before the plant was completed and installed, we've almost had a full order book to the end of the year, and it's going into 2021 to the extent that we're potentially or looking at how could we actually increase the volumes of that line because of the sheer demand for those products. It is definitely going to be part of our growth story going forward. Vancouver Island, we were always looking at entering the lower mainland BC, and we came across a tiny and older facility, which gave us an exceptionally low cost entry point into Vancouver Island. And what we've basically done is we have started looking at what equipment upgrades could look like for this business, etc., etc. And just in percentages from what we inherited on day one, by the very next month, that was a sort of a doubled. And the next month, the revenues were doubled. And albeit from a small base, it is super exciting how that business is actually growing exponentially at this point in time. And we're looking forward to some exciting stuff into 2021 from that business as well.
Why don't we talk a little bit about what you see over the last sort of, the period that you've been with the business now, because you've been there several years. What do you say is working well? And then the flip side, where do you think you need to improve?
I think what is working particularly well at this point in time is we got to this stage where we have a settled team that has been growing from private ownership to a more controlled and diligent sort of a leadership team that is operating in the public space. So that is making a huge difference for us, because what happens is now you've got the guys, they've got the credibility going out to these plants, and it makes a huge difference. The second piece that I think that has really worked for us is delivering and building out on our sales strategy, our sales systems, etc., etc. And that paired with streamlining on the factory floors, production flows, and all those sort of things. It is very important for us to actually look at that. I think what we have learned over the last few years is to streamline our M&A activities and due diligence when we're looking at specific opportunities. That has come a long way. We have developed and designed new methods and or very creative financing strategies for acquiring these companies. You know, for example, in the past, basically the recipe was up until about a year, 18 months ago, just after I've joined the group, the strategy was basically to look at an opportunity, raise capital, buy it, and then starting on it. Right now, we're looking at more combinations of, for example, mixing in vendor take-back financing or earn-outs as a component, and or equity portions and positions in these sort of acquisitions, so that you can lower the absolute capital cost and upfront cash outflow of the acquisitions. And I think that's really a big thing for us, where we've made a big change in our business. That's something that we wanted to make sure that we can actually achieve.
Mm-hmm. Fantastic. And then, so looking out to 2021, you mentioned that you guys have a pretty strong order book.
Mm-hmm.
I mean, give me a better sense of what that looks like. Do you reach capacity? Do you not reach capacity? Is there some sort of color in when you're able to deliver on the book? Because, you know, we're still in COVID. There's still some, you know, labor shortages. Give us a better sense of how you see the next sort of 6 to 12 months rolling out.
I think the order book is definitely very strong from what we see today. And I believe that over the coming weeks and months, we're going to see that actually strengthening as there's more and more bigger projects that's coming up. In terms of capacity for the organization, I want to remind our group here that our company is still working essentially on a 5-day single shift sort of a pattern. And yes, at times that is being stretched to capacity, but we supplement that with a little bit of overtime, maybe adding in some departments in some areas, or whatever the case might be, some extra labor, or maybe an extra shift, or whatever the case might be. But we actually have got left quite a lot of capacity as yet. Where we do have pinch points, we have plans to execute on our automation strategy there. And I can't say too much of that, but we're definitely looking at exploding on that front, or exploring on that front, and actually completing a couple of projects over the next number of months here in terms of that as well.
So it's obviously safe to say then, plenty of capacity. You guys could continue to grow, you know, with existing facilities. Mm-hmm. Do you see any significant capital costs going into 2021 to really sort of handle what's out there?
I think what we're going to see is probably a very modest capital expenditure in 2021 for some sustainable capital activities, and then there may be some opportunities for us to do more automation in certain areas of the plant that we really want to address, versus addressing it just with hands. I'll give you an example. Back in 2019, we bought a high efficiency saw. That saw was installed at our Nanaimo operations. What has happened is it literally replaced 3 saws, and it added capacity, 60% more capacity. Wow. Once we've replaced it. That is a very short payback period when you start looking at it from that perspective. Where we have opportunities for that, which we've identified, we are certainly going to look at some capital for that, but we're talking about modest capital outflow for that.
Mm-hmm. And when we talk about geography, I mean, we've got facilities in a number of different parts of Canada. Are you seeing certain strengths or trends in any of the different geographies you're in, good or bad?
I think what we're seeing right now at this point in time is that all the territories that we're involved in is on fire. It is really, really trending up, and it's trending up aggressively. What was quite evident during the pandemic was that geographic footprint was actually one of our core strengths, because not all territories were created equally or were impacted equally. And they had different impacts from on the labor side, on the spread of the pandemic, etc., etc. And what has happened is it really hedged the risk and spread the risk across the group. And the whole group at the end of the day was better off because of a result of that. Like, for example, in some areas, we had competitors that were seriously impacted, but they had a one region show. And really, it was really struggling for them. Our BC operations, for example, it never even sniffed it went on. We had a lot of commercial work. We had a lot of residential work, etc., etc. And we never missed a heartbeat on that side. Whereas one of our locations, for example, in the east, were more impacted than the others. So from that perspective, that geographic strength in this sort of environment became a huge benefit to the group, and actually a key strength or a key factor. But definitely right now, from where we are, all the territories are have a lot of work. There's a lot going on in terms of development at the moment.
That's fantastic. Earlier you touched on some of the issues around the volatility of costs, specifically around lumber. How does that get managed in 2021? And do you have any sort of insights in terms of how, what are going to happen to your input costs in 2021? What do you think?
I think what we've seen during this year is you're looking at, for example, the cost. And now, depending on plant, your material input as a percentage of your final product sale value at the end of the day is probably around 20, and depending on the plant, like I say, 25, 27%, in that sort of a range. So the impact at the end of the day in a massive jump in that is also offset by efficiencies in labor and all those sort of things that you could look at. That being said, yes, 2020, for example, there was huge lumber volatility. I think at the lowest point, and at very suddenly, the lumber price dropped to about $267 for 10,000 board feet, and at some point it was over $1,000 here in Q3. Atlas has got a unique model. What we've done is we actually hold quite a bit of inventory on hand, but it is a pay-for-use system. Mm-hmm. So, for example, is inventory would come in, we would, but we will only pay for that at the cost that it came in when we're actually opening up that pallet and start using it. So from that perspective, because we can carry a little bit more inventory on hand, it really gave us the opportunity to manage these big peaks, etc., a little bit better. When it suddenly drops, the inverse is there, and you need to make sure that your contracts, etc., is in place to actually make sure. You know, during this year, at some point, we just said we don't guarantee an order for 30 days or a quote for 30 days. It is now we guarantee it for 14 days. After 14 days, the price revised. As simple as that, just to manage that, and that continues. We make sure that we actually manage that price risk effectively during the group. And you can see that in our results. There has been some impacts, but not remotely as close to the high volatility that we've seen in the lumber price.
So obviously, while not fully hedged, you have some measures that help you sort of curtail some of the top end and bottom end of the price, especially lumber.
Correct.
Fantastic.
Correct.
There's a couple of questions that are starting to come in. I'll sort of look through them as we go here. Yeah, okay. I mean, some of the questions around lumber pricing, but how competitive is the market right now? And are you still able to squeeze out, because you're somewhat automated compared to some of the other competitors that are still not automated? Is that truly showing up as a pricing factor when you guys are out there competing with these guys?
I think that I'm doing a lot of M&A discussions, and when I'm seeing some of the guys' margins, for example, or whatever the case might be, it is very interesting to see to what a degree what our pricing comparisons looks like. And I can tell you, not many companies in this industry actually makes big double-digit sort of EBITDA returns or anything like that. We're probably heading to be one of the leaders in that regard. So from that perspective, from what I'm seeing is from the competitive landscape, we definitely see ourselves. We're definitely not the cheapest, but we're definitely have got enough room to weather many storms within our margins.
Mm-hmm. And now back to M&A. So that's been sort of part of the DNA of the company up until recently. You mentioned you did a raise early in the year. You still have most of that cash. You've been able to pay down debt. So obviously the balance sheet's stronger than it was this time last year. Mm-hmm. Do you feel comfortable that you're in a position to acquire if the opportunity presented itself? Are you in a position to be able to do an acquisition?
Yes. I don't need at this point in time to go to the market to do a significant acquisition. If we do, maybe bank 1 or 2 or 3 over a series of months or whatever the case might be, and there's a real nice opportunity presenting itself, yes, maybe then we could look at that. But right now, from where Atlas is sitting, we do not need to have a dilutive raise or anything like that to help us to guarantee the next acquisition. Not necessary.
Okay, perfect. So a question has come in here. Do you guys aspire to be the cheapest provider? How do you answer that?
No.
Okay, perfect.
No, we're the highest quality provider. What we're doing is, for example, we supply our client with the ultimate in engineering capability. We're not aspiring to be the cheapest. We're aspiring to be the lowest cost producer, but there's a big difference between the two. I'd love to see, as we reduce our costs further and further, that margin all become profit. So the answer is no.
And I remember in a past discussion, the way you described it is not necessarily that the product you sell them is the cheapest, but ultimately it's the lowest cost to them because of the labor savings and others. So there is a price factor at play here, but it's not necessarily that you're selling it at the cheapest. You're giving them a product that allows them to basically end up spending less money.
Paul, think about this. What is the solution that Atlas is actually giving our clientele when we come to pre-manufactured walls? First of all, it's 2,100 square foot home. Let's use that example. That could take any time right up to lockup to under traditional construction methods, weather dependent, anything 8 to 10, 12 weeks that would take. The Atlas solution could do that literally in a number of days for our client. That's a huge labor saving. A. B is the scarcest resource in our industry is labor, framers. Kids don't wake up in the morning to become framers and say, hey, I found myself this next big career. What happens is there is a massive shortage of that. Atlas is actually giving our clients at this point in time, there's a pre-manufactured wall. And don't think modular, think high-end, think spec homes, think customized. That is what we offer our clientele at this point in time. We offer them the roofing solution. We offer them the flooring solution. From that perspective, at the end of the day, is the amount of time, money, and wastage or less wastage that they save on site is a huge factor for them. Huge factor.
Yeah, you know, one of the questions that come in, and is sort of the way he's asked it, it speaks to platform. What you're actually doing is you're building a platform for these these quote unquote construction companies to basically be able to scale even better, right? Mm-hmm. It's not so much that you're scaling, but you're allowing your customer to scale, because in the span of a certain amount of time, they could be building 5 homes instead of 2 with the same sort of on-site people, right? So it's a beautiful way to allow your customers to scale and rapidly produce more products at a cheaper cost. So I mean, I've sort of answered the question for you that somebody else has asked here. But yeah, so it's allowing a lot more efficiency for your customers. Okay, so let me see here. Yeah, so okay, well, he's suggesting we keep using the term platform as a sort of a marketing tool for the market. But let's talk a little bit about sort of go forward a little bit. I mean, let's assume there's a potential for M&A. Well, obviously, the opportunities have to present themselves, and the timing has to be right to get that done. But what other new initiatives are you guys looking at? We've talked about spreading the product line a little bit more. You know, we're doing you know, floors, we're doing walls, obviously we're doing roof trusses. Do you see anything else you know, coming down the pipe?
I'm thinking there's an opportunity for us to do a little bit of pre-manufactured floor panels, for example, maybe even roof panels down the line. It's not a high priority item for us really at this point in time. It is you know, first and foremost, my team, they hear this every day from me, but cash is king. So we make sure that whatever we do is to drive costs down and to make sure that we actually increase the efficiency and productivity in our factories. I believe that our automation activities over the next 2 to 3 years is going to be absolutely crucial. That's outside of the M&A side for now, just park that. But our organic growth is going to be driven by what we're doing inside of the factories today. So big focus on further improvements on the factory floor, further workflow improvements and automation on that. And we will be continuing driving that platform over the next few years here.
Dirk, what keeps you up at night now?
I think really at this point in time is to see how we're going to actually make sure that the volumes that we're booking at this point in time, we're going to make sure that it is delivered at even a lower cost than we do today. We need to make sure, for example, and we're working very hard on that, that we're spreading the sort of a seasonality and that sort of a sting through geographic, different geographic areas. You know, for the longest time, we were very heavy revenue dependent on Eastern Canada, for example. Now that we're actually building Western Canada a lot stronger at this point in time, that revenue profile almost equalizes itself out a little bit, etc., etc. Those are the things. It's timing differences for us. That's the things that we're working on.
Mm-hmm. I've got another question here that asks, how many territories are you selling wall panels in?
Right now, we're selling it into essentially all of Vancouver Island. Mm-hmm. We're doing it in Ontario. We have done a trial in Manitoba, but we haven't got a plant running there yet. So it's basically the Ontario and the British Columbian markets at the moment.
Okay, and obviously potentially into Manitoba if everything starts to run.
Correct,
well.
Correct.
Yeah.
Now having said that, we have done quite a few jobs in the United States last year, mm-hmm. Just across the border there from Ontario. Now this year with the pandemic and access across the border, etc., etc. We haven't done a lot of that, but there's certainly a lot of pricing out at the moment.
Mm-hmm. So we've got a question around M&A again. What geographically, where do you want to focus any attention as far as M&A? Do you want to expand outside of the territories you're in, or you want to, you know, increase? Obviously, there's a couple of facilities in Ontario. Do we go and look at more facilities in Ontario, or do you want to go, you know, in Alberta, for example, or somewhere else?
I think we dream of being a full national player, and hopefully one day slightly bigger than that as well. So our territories are not, and our focus areas are not limited to Ontario and or British Columbia. I'm working on a number of different acquisition opportunities, and we're looking at all sorts that's available across all territories in Canada. But I also trying to, at this point in time, make sure that we have an effective reach. Now in Ontario, for example, we've already got 3 facilities there. Can we, from those 3 facilities, effectively deliver through our network, regardless of where in Ontario? And the answer is no. So there's still opportunities for us in, for example, Ontario. There's opportunities in Manitoba. You've mentioned Alberta before. We need to be very careful about some of those economies and just make sure that you buy it at the right time and that the timing is perfect for those, because they are very dependent on other market factors, such as oil and gas, and with all their cyclical natures as well. British Columbia offers some nice opportunities still for us to pursue. So really, at the end of the day, we want to be a true national player.
Do you ever look at the idea of starting a facility from scratch?
Yes.
Okay, so that is an option if you saw it. Okay.
You know, really what you need to look at, for example, is our Novum facility that we started in Lower Mainland BC. That's probably the closest as starting up a brand new facility from scratch. It was tiny and it had old equipment in it. What we're really doing at this point in time is building that facility from the ground up. If we cannot go into enter a territory in which we're genuinely interested in, we will look at a way or a mean to set up a facility in that if it makes financial sense.
And you know, the COVID chaos, we'll call it, over the past almost year, do you think that's created more opportunities or fewer opportunities for M&A?
I think, no, not I think, I know it has created more. I'm working on with that every day. You know, I can't say too much, but on all those fronts. But what I can tell you categorically is it has not only opened up more opportunities, but it has also opened up more creative ways and openness to look at more creative financing opportunities for these. It's not only created more properties to buy, but also more financiers that is interested to finance. So it's a very interesting sort of dynamic that we're seeing. And then deal structuring also has been very favorably impacted by it, because people are looking at creative ways to finance transactions and deals at really historically low sort of costs or interest rates.
Fantastic. And then, you know, you mentioned earlier that you feel that one of your strengths is that your management team is sort of a little bit more seasoned and sort of understanding their roles. Do you, where is that? Do you need any new sort of staff members? Is there any weaknesses in the management team that you want to bolster? What can you tell us about sort of your I call it your management needs?
You know, right now, I'm very satisfied with where we are. Is there room for improvement? Absolutely. But what we any business, doesn't matter how mature you are, there's always room for improvement, etc., etc. Fact of the matter is, my team is busy delivering. There's no need for us to actually look outside the box or be adding any cost to the business. We've worked incredibly hard to become as lean as we are today. And if and when we bank our next rounds of acquisitions, hopefully some of those will come with really, really strong people on board. And or if not, and we have to bolster the team, we will go out and find the strongest people that I believe is necessary to grow and mold this business to where we want to take it.
Fantastic. Well, so I think we've satisfied all the questions that have come in from our listeners. I've run out of questions, which is a good sign. So we've covered a lot. What we always like to do is end with sort of an opportunity for you to give any kind of key message or an outlook or whatever you sort of want to sort of the listener to walk away from in understanding Atlas. What would you say to everybody?
I'd like to say that Atlas is and remains on a mission to consolidate this industry. What we have shown is that we can actually do that successfully, and that we will continue to actually grow our margins, our organically, etc., through the business. We're not, and we have not walked away from that. But what we have done is we've demonstrated incredible discipline to not do things too quickly, too fast, in very, very trying and or uncertain times. I'm happy to say that my team has excelled in making sure that they are delivering to those sort of expectations. Going into 2021, we believe that we're on a really strong path. From what we're seeing, a lot of work going into 2021, and that would mean well or bode well for us on the sort of a side of strong organic numbers to be achieved as well. I always say this: it doesn't matter. You're not buying companies in any space or consolidating them just to have a footprint. It doesn't matter what's the footprint. It's what you do with that footprint. Once you've acquired that business, what can you do with it? Can you actually expand that business? Can you organically grow that business? Can you make it more profitable than it was before? Because if you don't, you're not adding value to the transaction. If you can, that's where the money is. And that's what Atlas is busy doing. Thank you, Paul.
Thank you, Dirk. Listen, congratulations. I mean, it's been obviously a very trying, last couple quarters with the pandemic. You guys have put together a very solid recent Q3, nicely profitable. It looks like, as you said, the bookings going to 2021 look very strong. You've managed to integrate a number of companies, which integrating one alone is pretty hard work. But having done several. It looks like everything's coming out much stronger now. So we're really looking forward to what 2021 has in store for us. I think everyone knows I'm a significant shareholder of Atlas, and I'm really happy to have gotten this opportunity for this update. And again, looking forward to future updates from you and another hopefully strong 2021. So Dirk, thank you so much for your time today.
Thanks a lot, Paul. And thanks a lot to everyone in the audience. Thanks.
Appreciate it. Thank you.